All right, let's take the focus then to the equity markets, back to the equity markets, and get a fundamental view on the outlook there. We've got Vivek Mavani, who's an independent market analyst and portfolio manager, who joins us now in the studio here. Now, Vivek, to begin with, the Met refusing to officially call it a drought as yet, but I think everyone else seems to be agreed that this year is indeed going to be a drought year. Given that it is going to be a drought year, how would you be viewing equities?
Well, whether the Met Department and the government or other related government agencies call it a drought or not, the fact of the matter is there is an inadequate rainfall, and there has been there have been lapses even in terms of rainfall distribution. We have not had the desired rainfall or the monsoon that one would expect. Now, of course, one has also got to realize that calling it a drought or not also has political implications. It has implications on other things also. First and foremost is the rural demand, which has been led by, which has been driven by robust agriculture over the last about 5-6 years on back of high food grain prices, agri product prices, also driven by the prices governed by the ministry, in terms of procurement prices and so on and so forth. So it has implications there. There could be some slowdown in demand for sectors and that kind of discretion, more so from the discretionary point of view. On the FMCG side, selectively, yes, but we have seen the results of HUL and there's no sign of slowdown. Whether it's likely to happen in the coming quarters, well, one just needs to wait and watch. But we are clearly seeing it in some of the big ticket items, namely two-wheelers, perhaps even tractors tractors and utility vehicles could see some. So far we have not had a very large impact in that four-wheeler space, but we could see it going forward. But in terms of high-end FMCG, yes, there could be some sort of a pause in the penetration which was driven in the last 4-5 years.
Vivek, what would you make of some of the cyclicals, the likes of the sugar space, as well as some of the metals counters?
Well, as far as sugar is concerned, so long as we have a surplus that's getting accumulated within the system for the last couple of years and limited exports being permitted, the surplus is not being allowed to fully exported, sugar prices will remain soft. That's one part of it. Given inadequate rainfall and given that sugar is hugely water intensive, whether we are going to have some sort of dip in production in the coming year, in the next year, I believe it's still too early to really make a judgment on that. But assuming that is, then maybe there could be some respite in terms of production, consumption and the inventory dynamics, which could lead to some buoyancy. But the problem is that last 4-5 years since this surplus sugar that we have had in the system has had huge implications on the balance sheets of sugar companies. Most of them are over leveraged. They barely make money at pre-tax profit level. So even if sugar prices were to rise, they have to stay high on a sustained basis for the sugar companies to really come back into action. Till then, it's as far as sugar is concerned, it's largely going to be a trading play, and that's about it. Maybe one has a 10-15% trading play in that. As far as metals are concerned, it's largely governed by the global factors as to what's happening in China and Europe. Europe determines the sentiment, China determines the fundamentals in terms of both production and consumption part of it. And there are definitely signs of China screeching to a slowdown. It's not just a soft landing, but already people are talking of a hard landing. So as far as metal prices are concerned, whether it's ferrous or non-ferrous, whether it's aluminium, copper, probably one may not see very large rallies from what they are currently. What only helps the Indian companies is the currency impact, so that the dollar prices get translated into higher rupee revenues, but that's about it. Beyond that, there really is no play in metals as such.
So Vivek, 30 seconds, top trading ideas from the mid and large cap space.
Well, as far as the large cap space is concerned, I'll probably stick my neck out, continuing to, something which I've been talking about for the last couple of months is that dividend yields do offer some respite in terms of margin of safety amidst, that's the theme which probably can be played. So in that sense, some of the PSU banks could look good. We do know there are asset quality pressures and so on and so forth, but my sense is from the prices that they are, I mean, we may see fundamentally they're not performing very well, but from the price front, maybe the erosion may not be very large. So the risk reward probably from a 1 to 2 year perspective probably favors going long on some of these banks, like maybe a Bank of Baroda or a PNB and so on and so forth.
All right, Vivek Mavani, thanks very much
Thank
for
you.
coming in with that fundamental view of the equity markets and identifying sectors and stocks that you believe are good buys at the current juncture. Let's take it back to Rajat to identify his top trading ideas.
Yeah, I'm taking a contrarian bet on the Axis Bank future. It's a intraday trade. I put a stop below 1034 and target would be 1043 and 1047. And then Ambuja Cement seems to be holding out. So Ambuja Cement buy with a stop below 182.50, target 186 to about 187.20. This is also an intraday trade. And another buy call I have on USD INR August future. I suggest a buy with a stop below 56.10, target 56.52, 56.75 and 56.84. I perceive a lot of weakness coming into Indian rupee against the greenback in the near term.
Thanks very much for joining in and giving us those technical trading ideas, Rajat. We take a quick breather right here on Market Sense.